And there we are. What's up, guys? This is Patrick Petson from FX Legends, and I'm here today to make a forex video on forex for beginner traders guide PDF. So, as the slogan says, learn how to beat the market like a pro with the trading game. So today I'm going to simplify this PDF, especially for beginners. So I want you guys to understand what's actually behind the forex and how it actually works. All you can leave for me, guys, is just a thumbs up, a share, like, and subscribe to the channel. Please subscribe to the channel, guys. I'll be doing one of these if I have a lot of subscribers, so that we can actually get motivated and go drive on. So let's get started, guys. So what is forex? So, guys, as said earlier, this is the simplest way to understand this in the forex market, guys, because it's a market, guys. It's the biggest market in the world, guys. So in the forex market, guys, you should understand that almost 5.3 trillion is traded daily, making it the largest and liquid market in the world. So guys, it's the most liquid and hugest market in the world. 5.3 trillion, I mean, that's the highest, guys, I can think of. So the trade in forex occurs between two currencies, because one currency is being bought and another sold at the same time. So this means that we exchange currencies, guys. So as we see, the one thing you understand already is that it is the largest forex marketing, and the second thing is that in the forex market we are exchanging a currency for another one. So like we have our majors like Euro, USD. Majors are those that consist of USD, making their liquidity higher. That's all, guys. So like for example, Euro USD, guys. For example, let's say the selling price, which we call it as traders, bid, and the buying is, we call it ask. So let's say I have the price of two currencies, which is maybe for Euro to USD is 1,230 to 1,230. So look at the last number there, which is in green, which is 2 for what this Euro for Euro, and so it's 1,232 and 1,234 for the US to the Euro. So the difference between the two we call pips. So look at the last digits. The difference between the two is 2 pips, or you can call it point, which is normally known as the spread. So why do people forex, guys? With forex, guys, you can start with a minimum of $100 US, but with some brokers, guys, like XM and others, you can start with a minimum amount depending. Some it's $1, some it's from 100, some is from, they have these different minimum setups. So we trade cause you can work while lying in a hammock. So you can be chilling and then you just trade. The market, it's not about you being straight on a computer or straight on something that's serious. This is not a game. So here, guys, you can trade on your cell smartphone or anywhere. So there are no crises, guys. Even during a financial crisis, you can still make money trading forex market. Any escalation in the currency can be taken advantage of by going long or going short, whether a market is bullish or bearish. You can trade either way with forex, unlike stocks or other financial instruments. Learn from pros with social trading, guys. So you just you go on their media and see their trading strategies, and then you just you copy, because forex has easy rules. The forex market is quite straightforward as compared to other financial markets. With stocks, you can have to analyze company reports and choose. Forex markets generally revolve around 8 currencies known as majors. Put simply, the better a country's economy is doing, the better we expect there to perform. So that's how it works, guys. Strong currency, strong current what this economy. So it's easy rules, guys. The better your economy, the better the currency. How to trade if you're a busy person? If you're a busy person to follow the news and monitor the charts all day, it's possible to participate in forex trading in an easier way and less time consuming way. Social trading allows you to connect with experienced traders, see their performance tactics, discuss how trading ideas, learn from their mistakes, and obviously copy the successful strategy. In essence, you're making professional work for you, you know. So guys, for you to trade, guys, you have to choose a platform, you know. So under a platform, you're going to choose your brokers, you know. So these are your biggest institution that have access to the market, and they give you that, so you're able to trade under them. Even if you are new to the forex, there are beginner friendly platforms like eToro, 10 million users that offer you interesting opportunities to follow the best traders and copy the transaction. Follow top traders. Discover traders you want to follow and add to your watch list. View their past performance stats, read status updates on their strategies, analyze results, and communicate with them. So we call this copy trading, guys. So copy trading is for those I say they are lazy, but don't take it the wrong way, guys. Just that for me, I do my work on my own. So some people are busy and they don't have time to learn forex. So you just copy trade. I mean, I just send you a signal. I mean, yeah, you make money, but is that what you want? I don't know. It's all up to you. You can choose and tell yourself that. So you at the same time, guys, with forex, you can choose to learn and make profit. Whilst you're learning, guys, you can sit back and watch your experienced traders do the work for you. Your task is actually carefully analyze their results and learn as much as possible from their trades, guys. So you are just sitting back, relaxing, drinking something, of course, and then they just do all the hard work for you. Not really my thing. So how to read currency pairs, guys? Currency pairs are traded in pairs as their value is relative to another. The first currency shown is the controlling one in terms of placing your order, guys. So if you see a euro USD, then always choosing to buy or sell first currency, which is the euro, against the second currency, US dollar. So the first one, we call it a base currency, and the second is it's a code currency. So I'm always trading the base to the code, the base to the code. Remember that it's the first one. The base is always equal to 1, and then the second one has a different value to the other one. So the base must always equal to 1. Always remember that it's always equal to 1. So we have our majors. Our majors are your currencies that include USD. As long as it includes USD, because USD increases the liquidity. So there's higher liquid if you're trading a currency with US dollar. US dollar increases. So guys, if you don't know this CHF and what this all means, I'm gonna make another video on what they all, so that we can all be on the same page and understand what's happening. But we do also have popular crosses that can get you a high liquid too, like GB to Japanese yen, all this euro to GB, excluding the USD, and also exotics. I'll go later on that too, guys. So majors are widely traded by beginners, as we said earlier. So the exotics, guys, currencies pairs are less traded and so much more costly to buy or sell. Don't let the cost fool you off, guys, because many of these greatest traders of all time made their fortunes with exotics. So exotics, guys, on my side, I do not actually like them. Yes, it consists of this. It has one currency that's powerful than the other one. The problem is that the other currency is way dominating than the other one. So having a dominating currency will not help you, because you are trading a powerful currency to a weak one. For example, USD to ZAR. Already USD currency. It's a strong currency, and ZAR is very weak. So the liquidity, guys, it's not. I wouldn't say it's a go off, but you are not actually likely to get a clean go off, because with these, guys, you're actually putting much at stake. These are unknown currencies, and you cannot monitor them much easier, because popular ones are the one that we call majors. So popular ones, you have higher chances, unlike the exotics. But we do have popular exotics that can actually have high liquid. Not to say that all exotics are bad, you know, but just saying that go for majors, guys, as a beginner, unless you're pro. What is leverage, guys, and peep and spread? Leverage, which represents, yeah, yeah. So Leverage, which represents a margin trading ratio, enables traders to borrow a certain amount of money that allows them to trade in much bigger deals. Moreover, leverage allows one to trade using more money than they have in their account. Therefore, therefore you leverage your account balance in place to place bigger trades. Currency rates move very slowly. This makes small trades unfashionable as they only return small profits and losses. For every pip rate changes, therefore, leveraging helps one to trade in larger deals, hence amplifying their potential profits and losses. So let's say, for example, right, you have 50 rands in your account. So depending on a broker, some brokers they give you higher leverage. So your leverage is actually that they are giving your money more power, more buying power. For example, maybe 1 is to 100. So if you have 50 rands, 50 times 100 is what? You have almost 5,000 buying power. That's how leverage works, guys. So you have 5,000 buying power. So leverage starts from 1 is to 25, depending. That's the lowest I know. So that's how leverage works, guys. You are able to buy larger, but therefore increasing your risks. You get me, guys? So according to the new ESMA intervention measures, leverage rates can only be offered between a margin of 2 to 1 and 30 to 1, depending on specific instrument. So not every leverage falls for the same instrument. So let's go to the next number 2, PIP. So PIP, which is a price interest point, represent the small change in currency pair. Typically, it's the fourth decimal place, although many broker quotes using the fifth decimal place. However, the fifth doesn't really affect the price as it's changed really quick. Currency pairs that includes the US dollar. A PIP is 1 is to 10,000 of a dollar. So whereas when the currency pair includes the yen, a pip is 1 is to 100 of a yen, because the yen is closer value to 1 is to 100 of other major currencies. This only falls between the two, one that includes the USD and the one that includes the Japanese yen. So we have euro to USD here, pip or point, what you wanna call it. These are points or pips. So the fourth or fifth, depending on others. So the fourth changes, and let's say the fourth, we minus pips to the other. So the pips changes, increasing your what? The value of the currency, or decreasing the value of a currency, depending on the time that you trade and how you trade it. So the pip is actually how we count our profits. So my pips are changing because the market is going higher. For example, it's going bullish, so the pips are changing, meaning that I'm actually getting higher amount, or I'm getting more money or points. That points will be exchanged for money. I will make another video on the prices of each pip. So we're moving on to spreads. In forex trading, brokers quote the bid and the ask price of a currency pairs. That is the price that a trader can sell the base currency, while the ask is the price that they can buy the base currency. Spreads refer to the difference between the two prices. Besides, this is how the non-commission brokers, those who do not exchange a separate fee on traders' transaction, make their money. So they take money. I won't say this in a bad way. So this commission, this is how they actually take money. That's how they make the money. So let's jump into how leverage works, guys. I've explained it, but I actually wanted to make it much more clear to you guys, so that I know the first thing that comes to your mind is that you want a higher leverage, because wow, more buying power means more money. But at the other part of it, you have to understand that leverage in forex, guys, is all about entering a borrowed capital into transaction. The money is borrowed from a broker who acts like a bank that fronts you some cash to invest, which is the case to buy currencies actually. So take the option below, guys. For example, leverage 1 is to 20, which I'm going to use as example A, and leverage 1 is to 200. Investment, I use 100 for all, let's say, right? My leverage is times 20, and then my leverage here is times 200. Position size, the buying power For A, which is 1 is to 20, is 2000, because 20 times 20 is literally 2000. So for the next one, it's 20,000, because 200 times 200 times 200 is equal to 20,000. Change in value is plus 0030, guys, which is very huge. So the profit between the two, right, if I use the leverage, my profit here would be $6, while here is $60. Balance in the account is actually 106, and here it's 160. So when we remove the money that you used, guys, you get a $6. And when you remove your money that you moved for B leverage, it's actually $60, guys. So that's how leverage works, guys. So with the margin, guys, trading ratio leverage of 1 is to 2, as you see, you can see that. So literally you can see that some people would want to risk more, because higher leverage means the higher risk, and others want to risk less but you make a profit. So with leverage, I don't suppose you go higher than 1 is to 200. There is even 1 is to 3,000, but guys, please listen to me carefully. Do not go for 1 is to 2,000. Don't do that. Just go for the lightest. 1 is to 200, that's your maximum. Otherwise, that's all from me, Patrick Petson from Forex Legends. So guys, I'll see you guys next time. Tune in next time. Subscribe. Don't forget to subscribe and like.